November 13th, middle of the quarter. And for 3 weeks now, we have seen oil prices drop, closed the last 3 weeks down for the first time in 6 months, and opening up again this Monday morning in Asia with Brent down about two-thirds of a dollar, if you want. But nonetheless, this sort of, after a somewhat recovery on Friday, we're seeing prices open weaker today, and it would appear the sort of demand outlook is somewhat somber for the new year, and having a dampening effect on prices, particularly the continued uncertain outlook in China. Let's kick off, as always, Monday morning with Omar Najia, Global Head of Derivatives at BB Energy. Omar, it must be getting more and more difficult to be bullish. Time horizon is everything, of course, but your thoughts this Monday morning?
Yeah, I mean, I think basically that I think this market still has another low to find. So WTI is trading whatever 76, something like this. As I think it has a good chance of getting to maybe like low 71, 72, 70, even something like that. But then basically we're bullish. So I think this is so we had a massive move up, and then we had basically this kind of retracement that's going on. So the massive move up ended in kind of September at about 95, something like that on WTI, and then basically we've been coming off. So I think it has a little bit slower to go and then higher. But then I also don't think I think the S&P is going to set new all-time highs. I'm not a subscriber to lower and all this kind of doom and gloom or deflation. I'm quite the other way. So I think inflation. I think the target on the S&P is going to be like 5,900. I think the target for oil. So what I like about oil is that yes, we could go from here to, let's call it $71, right? We could go to $71, but the next 10, 20, $30 basically, in my opinion, are going to be to the upside, not to the downside. So I think we're getting close to a place where the market will start buying this thing strategically. Same with the S&P. I think that reversal we saw last week, or maybe the Friday of the week before that, I think that's very, very significant. And I think you still have a lot of disbelief. And I think that prices going up, equities going up will hurt a lot of people. And I still don't think that anything to do with the Fed at 5% is doing anything at all to slow down anything. So lots of companies, take Apple for example, right? They sold 30, 20-year debt at like 1%, right? So if the Fed has its rates at 5%, they're actually they can actually make money, right? So this raising interest rates is stimulatory to big companies. To tiny little companies, they're stuffed because they have to go to a bank and they get very high interest rates, blah blah blah. So it's leading, I think basically inflation. So I think higher across the board.
We look at China, of course, for always an indicator as to the strength of the demand market. It was the biggest importer in the world of crude oil, and China continues to disappoint. We're seeing consumer prices fall to some of the similar lows that we saw during the pandemic in October. And refiners in China apparently looking to tell Saudi Arabia they didn't want as much oil as originally thought. Let's welcome back to the table Victor Yang, Senior Analyst at JLC Network Technology. Victor, deep into the fourth quarter now, your thoughts on the outlook for demand in China?
Good morning, Sean and everyone. Well, we are looking at declining demand from China in the last 2 months because refineries are cutting their operating rates now. For one reason, domestic demand, fuel demand is declining. It's an off-season now, and refining margins have plunged, particularly since the second half of October. Say for independents, the margins were even negative for some time. And oil majors, state-owned oil company had time quota on oil product exports now. and they cannot export as much as they did last year. I mean, the same time last year. And so this is now resulting in declining demand from China at the moment.
Have the Chinese teapots and others have the requested, Victor, for greater quotas to import more? Was that not a report that was out recently that they want quotas to import more and they've exhausted their existing quotas? What's the outlook on that?
Well, teapots had almost depleted their quota for this year, and so basically they cannot import much more crude in the last 2 months, but they had applied for some fuel oil quota, so they import more fuel oil for the last 2 months or the last quarter. And it was said that the government had granted them some additional quota on fuel oil, but not on crude. So basically they need to supplement the feedstock with fuel oil and diluted bitumen in the last 2 months. Yeah.
Jamie Ingram, senior editor at the Middle East Economic Survey. Jamie, looking at all these tea leaves, if you're in Riyadh or Moscow or wherever the decision makers on the next OPEC Plus meeting, where do you think they're putting their focus? What should they be guided by?
Morning, Sean. Yeah, certainly, clearly this is not the situation that guys in Riyadh in Vienna were hoping for heading. We've got 2 weeks to go until the next OPEC Plus ministerial meeting. Prices have softened quite considerably over the last week or so. Never good omens heading in there. I think the focus for everybody's clearly on these Saudi voluntary cuts, and I think they're going to be looking at the situation in China, as Victor was talking about there. That's quite a bit weaker than people were perhaps expecting. One of the issues at the moment, of course, is that we're starting to, front month futures are trading January now. Q1 data was always expected to be to see demand soften a lot on a global scale. So to that extent, a bit of price softening is not unexpected, and frankly, it looks as if we'll see the focus more on continuing to curtail supply as much as possible. I think that one thing that we are going to see is a bit more of a focus on some of the players in OPEC who are not complying as much as they could be. And unsurprisingly, that's perhaps going to be looking at Iraq in particular. Iraq got a bit of they managed to boost their southern production considerably with the outages in Kurdistan. And while some of the smaller players in Kurdistan, the IOCs there, have managed to start incrementally bringing output back online and up steadily over recent months, selling into local markets, that hasn't been accompanied by a comparative decrease in production from southern Iraq's big fields. And so we're seeing Iraq overproduce by quite a considerable amount over the summer. And even though for us, Iraqi production dropped a little bit last month, it was still about 100,000 barrels a day over their OPEC Plus allocation. So
they had to come out on Friday and sort of reaffirm their support of OPEC Plus. Clearly, they've been coming under a little pressure.
Yeah. So I think that all of the OPEC secondary sources came out and said that they were overproducing. We've had them overproducing quite considerably for quite some time now, but it's pretty much unanimous that they are not complying at the moment. So I think they're going to be copping some flack come Vienna in a couple of weeks' time.
Omar, we have, as you mentioned in your earlier comment, the sort of variety, the different markets at play, and whether the equities are still to reach new, further highs, and the outlook for this year has always been, recession is coming. We're still seeing those headlines on Bloomberg and elsewhere. It's sort of like a broken record at this stage. Yeah. What impact do you think that has on the market, or have become immune? Your thoughts as we go into the end of the year, obviously into the new year. Does that mantra continue? Does it continue to deliver a dampening impact on the market, the bearish impact?
But I mean, it's very interesting. If you look at the Bloomberg model to do with equities and all the rest of it, and forecasting recession, is heavily weighted towards the differential between the 5 and 10 year treasuries. But to make things simple, this year, I mean, you know, so what they do is they look and they say, like, in 1980, 1990, 2000, 2008, 2012, whatever, they basically say, if you look back, then the numbers say that, you know, 2023 has nothing to do with 2010 or 2011 or 2012, has nothing to do. I mean, it's like comparing, you know, apples and oranges. So I think the problem that Bloomberg and people who were looking for basically recessions, all the rest of it, is quite simply that, you know, wars are inflationary. You have two now, right? With the US expending major, and the West in general, major amount of money basically in Ukraine and Israel. So that's inflationary. If you look at the election, 2024 November, you have an election coming up. I've never seen any government go into an election and say, you know what, we're going to cut spending, we're going to raise taxes. It's not going to happen. So basically, that to me basically means that the market is going to continue to be inflationary. Look at their budget deficit. Their budget deficit is ballooning. I was assuming they were going to have a budget deficit in 2023 of 1.7 trillion. Now it's 2.02. So that money, that spending cannot be deflationary. The other thing is, what happens to budget deficits, to spending, when you go into a recession? It increases. So if it's already 8.5% of GDP, when basically the US is at full employment, then if basically you go into recession, that 8.5 is going to balloon. It always does in any economy, because they start to spend to stimulate and all the rest of it. So that's going to be even more inflationary. So unfortunately, I think that, and you can look at treasuries, and you can look at the dollar, and you can look at the kind of inability of the US to curtail spending and live within its means for political reasons. So I don't think it's going to get better. I think it's going to get a lot worse. And I think you have the same kind of thing that's slowly going on in Europe, definitely in the UK. And unless they kind of, you know, manage it, China itself is very interesting, because China is clearly deflationary, but you've also got the decoupling between East and West going on. So I wonder how much of that deflationary force gets basically shoved on or pushed into the West. But in general, I think basically so consensus says oil price, like, you know, Bloomberg, oil price is going to zero, Bitcoin's going to zero, plus or minus. S&P is going to zero, recession is going to, commodities are going to zero, right? So that's one view. That means basically you believe that, you know, deflation, recession, and that's it. The other camp is much more the other way, which means it's a binary kind of market. Inflation means everything goes up.
Victor, I mean, looking at obviously the outlook for China, it continues to be a softening, but at the same token, you know, the GDP growth is still forecast to be 5%, if not more, this year by many independent analysts, including obviously the Chinese government set that target. When oil prices are in this range, 80 and maybe even lower, obviously Russian oil lower with the price cap and so forth, but China usually get into the market and buy when they see the deal on the table. Do you expect the Chinese to do so on this occasion? If we see prices continue to soften, well, obviously WTI already into the 70s, does that present a buying opportunity? At least in the past, the Chinese have done that. Will they do it on this occasion?
Well, not quite sure yet, I think, because it's now quite a different moment. And China said earlier this year it aims to keep the country's refining capacity at no more than 1 billion metric ton by 2025. And its refining capacity is already very close to this ceiling. And some independence will be removed. And now competition is getting stronger than before. They had to integrate oil refining and chemical production to enhance their competitiveness. Otherwise, they will be phased out. Not just independent refiners, but also oil majors, I mean, state-owned oil companies too. trying to integrate their oil refining and chemical production and improve their product mix to be more competitive. And now domestic price are quite weak. I mean, compared with crude. So refining margins are not good now for this moment. And there are some other reasons too. And so the overall situation environment is not so robust at this moment. They might be waiting for a better opportunity. Yes, but demand is going to be rebounding next year because more refineries will still come online next year before the government can remove more. Yes.
And in that, when you see the import numbers, what do you think they look like? For this month, November, December, January, are we closer to 10 than 12? Where do you see the import numbers in millions of barrels?
We expect it to drop from the October level to about 11 million barrels in the last 2 months, say in November. And in October, we had this number at 11.5 million barrels per day. And it already rebounded quite significantly from the previous months, from September, because sometimes the custom numbers can be quite different because some customs declarations, I mean, sometimes it's not an actual demand reflection of that month, because say in August it was very low, and then in September it jumped to a very high level, and then sometimes it can fluctuate quite significantly. But in the last 2 months, because of weakening domestic demand, tight quota, bad refining margins, the number can be about 11 million barrels.
11 million barrels a day of crude oil imports into China over the rest of the year. Jamie, I'm not sure if you followed, but strange story over the weekend in the FT and elsewhere. Oil majors, BP, Shell, calling on Washington and Brussels to intervene in a LNG dispute where a company known as Venture Global is basically not meeting their contractual obligations to deliver LNG to Europe and instead selling it in the spot market. I mean, the bigger picture here, China or Europe's vulnerability over the winter with gas supply. But this story in particular, are you any insights on that?
No particular insights on this particular issue, to be honest with you, Sean. I mean, yeah, certainly the situation in Europe is much less perilous than people were concerned about going into winter, and that's, clearly this means that the potential revenues and profits on offer for LNG suppliers selling into Europe are less than many would have expected. So the fact that suppliers are looking to other districts to see whether they can make greater margins is not particularly surprising. I think, the greater issue that we have to be looking at is I think that China, clearly, again, on the LNG markets is a big player here. There was a lot of concerns that rebounding Chinese LNG demand this winter would pull a lot of volumes away from Europe. That hasn't happened to the extent that a lot of people were concerned about. Chinese demand is still, it's outstripping others, but it is not as phenomenal as perhaps would have been concerned. And so the supplies into Europe are not as fragile as they would have been otherwise. So generally, this is, if you're living in Europe, this is a good news story, arguably, because you don't want Europe pulling in too many excess cargoes of LNG, because that shows that there's a structural deficit on the continent.
It's just a strange story where it would appear, at least according to BP and Shell, that contractual obligations are not being met in major multi-billion-dollar contracts, if indeed that is accurate reporting by the FT. Let's go to the survey question, which looks a little bit on this question we started this morning with. Oil prices saw a third weekly loss in a row last week for the first time in 6 months. Will that trend continue this week as the bear got a grip of this market? And as somebody said last week, every bit of news gets a bearish interpretation. Omar, one of your favorite subjects this week, President Biden and the President Xi of China are meeting for the first time in a year. Does that present any direction of travel as sort of I mean, the fact they're meeting is positive, bullish, not bullish? What's your thoughts on that and any expectations?
Depends. It depends if Biden kind of goes in the right direction and actually shakes Xi Jinping's hand. He could basically go off stage. So nobody knows what's going to happen, least of all Biden. But no, I mean, to be serious, I don't know how much. I find it very difficult to believe that Biden can actually sit down and communicate with somebody. I'd find that incredibly difficult to believe. So,
well, he has translators.
Yeah, but you need somebody to. I mean, if
these meetings are pretty scripted anyway. Ultimately, there's not a lot of off the cuff stuff.
Yeah, but for example, they were trying to stop China from having these 7-nanometer chips, right? That Huawei came out with. So that's a total failure. All the stuff to do with Taiwan. So official US policy is Taiwan is part of China, yet they're arming them, visiting them, having, high profile meeting, all this kind of stuff. So the double kind of standards, lying straight to your face kind of stuff. I mean, I don't see what they're going to discuss, right? So whatever Biden says to Xi Jinping, his actions are completely different. So he says, yeah, it's friendship, I don't know what, blah, blah, blah. Then he goes and like sanctions, all this kind of stuff. So I think the Chinese are wise to that. I think the Russians are wise to that. I think the whole of the world is wise to that. Look at Gaza and Ukraine. War crimes here, no war crimes here. So I think the world is wise to that. I don't think any amount of talking is going to change anything. So I don't expect to be, to have like friendly relationships between China and the US, between Russia and the West, between the global South and the West. I think it's way, 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 way too late.
Victor, your thoughts on the same question? Ultimately, in China, how is this meeting viewed? Is this regarded as a big meeting? I mean, President Xi is going all the way to San Francisco. I presume he considers it important. What is the view, do you think, from China regarding this summit?
Well, I believe most Chinese people would not expect much from this meeting. I myself see quite the same with Omar. Well, the United States can talk the talk, but do you expect them to walk the walk? And just look at what they did after the meeting last year. Say quite different, quite the opposite to what they said at the Bali meeting. So, and the antagonism from the United States towards China will not change. We do not expect it to change. Not now, not in the near term. So we are still facing a lot of uncertainty next year, and this is a great challenge not just to China, but also to the world, because when the two countries cannot improve their relationship much, well, we are in a lot of difficulty. But the United States and China are actually trading a lot. So this is different from their political relationship. So the two countries can never move away from each other. They need each other. They need to cooperate with each other. But that's what is known by the Chinese people, by the Chinese leaders too. Yes.
I heard a very interesting data point over the weekend. The foreign minister of Singapore, who said that China's trade with Asia and with the global South, as it's now called, has this year surpassed its trade with US and Europe for the first time. The scale of trade that it has, I mean, that this interdependency with Europe and the United States, obviously still very big markets for China, but the growing obviously relevance of the global South, does that trend line continue, do you think? Obviously the politics would indicate yes. Your thoughts on that, Victor?
Yes, well, I think this trend will continue because China has very good relationship with these countries, and this can foster their trade. So quite different to the United States. So when the United States government is in the middle of their cooperation, it's very difficult. Say for the international flights between the United States and China, it's not until recently, this week, that they have added another light. For a long time, for months, they did not increase any international flights between the two countries. That's because of the government. So it's very difficult when the government is trying to sanction this country, sanction that one, and it may sometimes make cooperation difficult. Yes, that's for sure.
And just last question, Victor, as we haven't had you on with us for a while, the terrible events happening in Gaza and Palestine. Does China, do you think, expect China to bring any diplomatic muscle to help resolve this, or does China look at this as America's problem?
Well, China is calling for ceasefire, yes, and is now trying to help people there and trying to bring its people back from that strip. So for now, first it needs to ensure Chinese people's safety in that strip, and then it's trying to help to provide relief to that region. And at the same time, it is now trying to, well, call for peace between these.
But not really being too active. I mean, are behind the scenes maybe influencing Iran not to get involved, or?
Well, I don't see it getting quite actively involved there yet.
Yeah.
Not yet.
Okay, let's go to the final survey result and give Jamie the last word here. So yes, the trend will continue, the bearish trend going into the OPEC meeting. Jamie, on the cards of, what are the options on the table? I think there's general expectation, at least a growing, Jamie, that Saudi will extend its current unilateral supply cuts into the new year. I don't know if that's a false perception, but it seems to be growing. I'm wondering, is that enough? Are there any other tightening? I mean, we've heard little murmurs from the Minister of Energy in Saudi Arabia, Prince Abdulaziz bin Salman, recently sort of saying the speculators are getting it wrong. They're, in the past when he's done that, he's kind of come out with some bazookas and shocked the shorts, as he calls them, makes them ouching. Your thoughts on Jamie, is there any other tools in the box here other than a rollover of the Saudi unilateral cut?
Yeah, as you say, Sean, the Saudi minister does like his surprises, likes to spring them on the market in Vienna. I think that, as you kind of hinted at, a rollover of the Saudi voluntary cuts is kind of the baseline. If that doesn't happen, then we'll probably see prices drop significantly. So we've got to be looking away from that. As I also said earlier, we'll see, a lot of chat, I think, on how committed all the countries are. OPEC might be dragged up. Iraq might be dragged up and told to express very fulsomely how committed it is, and that it will be complying for its past sins and cutting production further. One of the big issues that we're going to see at this meeting is kind of fully assessing the production allocations for the African cohort in OPEC. So the likes of Nigeria, Angola, they were basically told, they signed up to provisional allocations for next year, and then we're told to go away and prove that these are valid. Frankly, they've kind of disappointed on that front in general. I would say that one thing that might be on the cards is potentially a further downgrading of some of those production allocations for the likes of Angola and Nigeria, who've really struggled to even live up to those reduced targets over the last 4 or 5 months.
Yeah, that would be, I suppose that you could get some additional, whether through those mechanisms you mentioned, or maybe even the likes of UAE.
That would
joining a voluntary framework.
Yeah, I mean, the UAE they were the big winners last time around. They got their 200,000 barrel a day increase to their allocation, but that's something that they fought long and hard for. So that's something that will be very much the last thing they want to do, is give up on that. So it could be a bit of a fight to claw that away.
It could be certainly a more challenging meeting than maybe one was expecting a few weeks ago. Never mind the geopolitics of everything. That's obviously the backdrop there as well. And well, hopefully, maybe by then, somehow this terrible tragedy in Palestine has found some kind of solution. Unlikely, but we'll see. Brent crude oil trading this morning down 50 cents, 80.91, and WTI at 76.63. So softening. Will that softening continue through the week? This room thinks it will. Let's wrap it up there. And thank you, Omar Najia, Global Head of Derivatives at BB Energy. BB Energy had a big news over the weekend. What was it? The rights to ship, was it Venezuelan crude or no, Guyana crude, wasn't it? Guyana crude. So congrats, Omar, to you and all of your colleagues there. And thank you to Jamie Ingram in London, and of course, Victor Yang in China. Really appreciate your insights this morning. Have a great week and catch up with you all soon again. All the best.
Thank you.
Thank
Bye.
you. Bye.
But